Hey, what's up, guys? It is Friday, and we are live on the Holy Macro Show. So much to go over today. The market's been in a choppy mess for a while. Then it just had a raging move to the upside. Basically, everybody who was short got caught. Who had short covering rally, and we're seeing that in multiple sectors. Whether it's technology, things like semiconductors are really moving across the board. We're seeing this in mainly the Nasdaq area. Um, don't know how long that's going to go on. We'll see. We'll talk about that a little bit today. I am currently long semiconductors. I know Kashop does not like semiconductors, so we'll talk through that today a little bit and try to see, what exactly we want to do with these positions. We'll talk about oil. We'll talk about gold, and we're going to definitely talk about the current state of the market, the war situation, and so on. So today, starting out looking at the dollar. So, want to pass this to Kashop for a second. What are you thinking about the dollar? Do you think that the dollar has more upside here, downside? Just generally, what do you think about the US dollar and US dollar dominance in the world globally?
So, dollar dominance, that's a very easy question to answer because we have it in the data. So, for the first time in probably 40 years, gold reserves, central bank gold reserves have surpassed central bank dollar reserves, meaning central banks now prefer gold to dollars as their dominant reserve asset. Now, that's a big switch and one which does not happen lightly because if you think about the way, let's say, a day trader moves, 10 trades a day. If you think about a way an institution moves, maybe 10 trades a month. If you think about something like a pension fund, they probably do two, three big macro calls a year, whereas a central bank action by committee, probably one each political cycle. So that's the glacial pace at which central banks move. And the central banks have decided that gold is a superior reserve asset to the dollar. Now, that's a shift that it's been a long time coming because, ever since 2000, when UK did that disastrous selling off all their gold reserves and Canada followed. So, ever since then, we have had a gold bull market, and everyone knows that those were catastrophic mistakes made by those countries. So, in hindsight, it's obvious. Now, when we look at what central banks are doing, they are preparing for the next leg, which is the dollar dominance to go lower and for gold to increasingly be used both as a store of value and maybe, just maybe, it's going to be monetized again at the central bank level. So, what we are seeing there is very clear: dollar dominance is decreasing. Now, when you look at the dollar index, so dollar index is basically just euros plus a little bit of pounds and all the other G7 currencies. So, if you're taking a view on the dollar index, you're taking a view on euros. And right now, it is very, very difficult to take a call on euros. And the reason for that is because Europe is so dependent on, it used to be Russian energy, then US energy, Middle East energy. So Europe is so dependent on energy imports that the current crisis is going to be very, very difficult for Europe. Now, when you have an energy crisis, what does your currency do? Well, it tends to tank because that's what we have seen across all emerging markets, across Africa. That's pretty much been the historical consensus that if you have an energy crisis, it's not good for your currency. So, looking at the euro that way, it is obvious the euro is going to head lower. So if the euro is going to head lower, what does that do to the dollar index, which is the offset to the euro? Well, it can go higher. But if you look at it purely in dollar terms, is there any reason for the dollar to go higher? No, there isn't. So fundamentals for the dollar are terrible, but the fundamentals for the euro are worse. So it is that situation which is driving this current stability or the range bound move in the dollar. So either way, this is going to get resolved. My guess is fundamentally the dollar has to go lower, but because of the euro situation, it may stabilize or go higher for a while.
Yeah, I do think that the looking at the euro is something that is consistently something we need to continue to pay attention to. I think a lot of people don't think about this, which is the euro is, I think it's 58% currently of the dollar index. So a lot of people just look at it and they're like, I don't know why you guys are always talking about the euro. And it's like, that's the reason, because where the euro goes, the dollar goes. And even if you look at some of these other currencies, the Aussie dollar and so on, the Kiwi in New Zealand, some of the emerging market currencies across the globe, you're seeing a lot more relative strength there than you're seeing in European currencies this year. Now, European currencies won last year. I'm not saying anything bad about it, and they're also shaping up very well currently. I'm just saying there's other areas that are starting to move. A lot of these commodity-based currencies are starting to look pretty good. Things like the Aussie dollar is one that continues to look great. And once again, these countries, they change over time. They change from capitalist, more socialist, and back and forth and vice versa. And so there's a lot of different things that happens with the currencies over time. But for the meantime, while that shift hasn't completely happened yet, we do see that people kind of run to them during certain parts in the commodity cycle. Same with people for years ran to the yen. Kashav and I used to talk about this one all the time and kind of laugh about it, which is the fact that people were still running to the yen as a safe haven, even though it's nowhere near a safe haven anymore. And it was kind of very funny for a long time, but at the same time, it was just what people do with their money. And so, continue to look at these commodity currencies as just commodity currencies. And I think either way, I think those are going to appreciate more than the euro, more than the Swiss franc, more than these European currencies going forward. And I think that's going to continue to put more pressure on the dollar. So look, the part of the reason I brought this chart today was looking at these peaks and troughs in the dollar. Now, if you look at the peaks, you'll notice most of the time when you see these peaks happen, you'll see big moves happen in things like the energy sector, other commodity-based sectors, commodities, and so on. So you'll see the energy sector had a big move in the late 80s. The energy sector had another big move, as everybody should remember, which is in the 2000s. And then the energy sector is currently trying to make a big move today. It really didn't start to move until this peak over here in 2025. It started to just bottom out, chop around. Then in 2026 is when we really saw this thing start to move. So, the other part of it is these green arrows. And I didn't highlight this the last time I brought this chart on, which is looking at the NASDAQ. So when we see the dollar get stronger, most of the time the NASDAQ also gets stronger. You start to see money start to flow in the US, flow into technology. Why is that significant? Because the US is the most dominant country when it comes to technology. It's the biggest part of our stock market. Where technology goes, our market usually goes, especially currently today. And that's been that way for some years. ExxonMobil was one of the biggest companies in the United States for many, many years based on market cap weighting. But that's changed over time, changed during the dot-com bubble, changed recently in the 2010s. And so going all the way back to even 74, you'll see the NASDAQ started to make a big move at the same time the dollar did. So if we go back to the dollar, you see the dollar's making a big move. The NASDAQ's also making a big move right around that time, starts to bottom out a little bit before the market. Same with the dollar here. The dollar starts to make a big move in the late 90s. The NASDAQ, as everybody knows, we're in this was the dot-com bubble. So the dot-com bubble happened, huge move there. One of the most significant moves in an index in history. And then we get to current state today. So basically, the NASDAQ was in a bear market for many years. Basically didn't break out until I want to say 2014, 2015. So it really didn't get to those new highs till 2014, 2015. Actually looks more like 2016 on the composite. The NASDAQ 100 looks a little different. This is the broad-based NASDAQ index. And so when we're looking at that, we're also seeing that technology started to move as the dollar started to get stronger. Then we were in the longest strong dollar cycle ever in history. So if you go back here, this is the longest strong dollar cycle in history. So you'll see these peaks are very quick, usually back in the 70s, 80s, into the 2000s or 90s. And then you'll see today, this is after the great financial crisis, the dollar started to get strong here, big move higher. Dollar starts to get strong again here, big move higher. So we've been basically in this uptrend of higher highs and higher lows for all these years. And technology has won most of that time. There was only one period here where we really saw a big move in cyclicals. We did kind of see a big move in cyclicals after 2016 and 2017 for a minute. That faded off, went right back to technology as the dollar went back into an uptrend. Same thing here, technology, the bottom that kind of happened in after COVID, technology really started to run again. And then we had the AI trade and all of this stuff. So all these things have happened over time. And now we get to today, and the dollar is weakening, and technology is holding up still pretty well. This is a lot of the move that happened from the AI boom and everybody going, AI is taking over the world, so we all got to be long technology. And then today, currently, technology is kind of stalled out. It's then rallied very recently and made finally made some new highs. So Kashyap, what are you thinking about the Nasdaq? We are talking a little bit about. I didn't bring a semiconductor chart today, but I know you've been talking a lot about semis. Wondering what you're thinking there. Do you think semis are going to continue to move higher? Do you think they're dead in the water? Do you think it's a scenario where it's just like a crazy melt up and then reality will set in? What are you thinking about semis? What do you think about technology right here today?
Yeah, sure. So I want to go back a little bit to what you said about how we saw cyclicals take off in 2016-17, and then it was back to technology again. But here's the thing, like what we do when we say technology is we lump in all sorts of stocks in different industries together. So if you look at 2016-17, so the bubble back then was in the FANGs, which was Facebook, Amazon, Netflix, Google. So Facebook is social media, Amazon is pretty much retail. So AWS was new back then. So then you had Netflix, which is again media, and then Google, which is the all around giant. So from then we got to this semiconductor led cycle starting from the release of ChatGPT. So if you look at all the interim cycles, at one point you would find XLK was strong, which is the broad technology sector. At other points, you would have found Amazon and Google and Apple and all these other platform companies dominate. And then at some point, you would find semiconductors dominate. So what we tend to do is we look at it as the NASDAQ composite or the NASDAQ 100 and say, it is all technology. But then there are nuances within that. And right now, if you look at it, we are looking at a semiconductor driven cycle, which is a hardware driven cycle, which is a capex driven cycle. Now, you really have to go way back to the dot-com bubble to see a capex driven tech cycle, because that was the era where your Cisco, which makes your hardware, your routers, your Lucent, so all your telecom stocks. So that was the era where there was a lot of investment being made on the internet. So 2021, if you look at that cycle, it was software, which was pretty much scalable thanks to AWS. Anyone could run any kind of website. And so that was a different era where those stocks dominated. And now you have this semiconductor driven cycle. And if you look at the way the semiconductor ETF is constructed, or even just broadly the category itself, it is all hardware. It is all about spending. It is all about building better and bigger data centers and getting the best and latest and GPUs and whatnot. So when you come to when you come out of a software driven cycle to a hardware or a capex driven cycle, what changes? Well, in a software driven cycle, what were people paying attention to? They were paying attention to your sales figures and saying this company is worth 10x sales because they have 80% gross margins. And now what are investors paying attention to? Well, it's completely different right now. Right now, investors should be paying attention to balance sheets, because this company is taking on so much debt in order to build this data center, and then they are going to lease these chips out. So it's very similar to, say, aircraft leasing or shipping leasing or even trucking. So, freight leasing. So, sorry, truck leasing. So it's a very similar setup to that. But these companies are getting valued the same way, meaning you build a data center, you make $1 million in revenue, you're valued at 10 million, even though your gross margins are not 80%, but 20% if that. And your debt service cost, thanks to the Fed, is now, say, 8% or 10% instead of 0%. So investors, because they have been valuing tech one way for a long time and looking at these capex light gross 80% gross margin companies, now they are looking at something very different in tech and valuing it the same way. So that is the core reason that I think this cycle will end in tears, because you cannot value a hardware company the way that you would value a software company, because the margins are different, the scale is different, the cyclicality is different, the scalability of your revenue is different. And I think investors are kind of blind to that right now. And I think they will wake up once the impairment starts, once the depreciation on the equipment starts to hit the income statement. So I think there are all these reasons for which investors will wake up and realize they are valuing these companies wrong. And I think at that time, we are going to be in for a big correction. Now, this is a fundamental macro top down view. So, how do you implement that in a trade? Well, it's very, very difficult. So, that's where I think it is very hard to reconcile these two views. When you look at it long term, you can see that yes, clearly all this capex spending is going to hurt everyone's balance sheets down the line. But as long as investors are valuing a multiple on the sales the same way they value the software sales, there's going to be a bubble. Now, when does it burst? How does it burst? What does it look like after it bursts? I don't know. But I think the way I would bet on this, and that's pretty much what I'm doing right now, is I'm buying all these software companies. I'm buying all these application software companies because the market says application software is useless, AI capex is everything. So I'm taking the opposite side of that. And I have three software stocks in the portfolio right now.
And I'm wondering, more the software. I know, a lot of guys at All Star are looking at software. They're thinking about it. A lot of people are looking at the how cheap it is, and there's always the debate about, oh, well, now with Claude you can build software in 5 seconds and all this. Building software, and the one thing I keep going to is building software is much different than actually managing a company selling software. It's kind of like, you become a business owner and you realize like you also have to be on social media and promote yourself. Like these are all different things that you don't think about when you're just starting a company, so to speak. And if they're good at that, they have branding, they have marketing, they're doing that. It's a big difference there. Then just, yes, I can go on Claude and build some garbage, and most of the time it's not going to work as well as something that's already been built by humans, actually. So, which sounds crazy. I know. Everybody thinks AI's changed the world and everything's great, but trust me, as a person who backtests, codes things, Claude is great, but it also makes a lot of mistakes. And that's normal. That's something we're all going to see with new technology over time. Yes, it'll get better and better, but over time, like, you're still going to want to do some things on your own. So I'm wondering, what areas in software should people be looking at? Are we looking at, cybersecurity? Are we looking at some sort of application for normal use? What areas in software? And you don't have to get into the specific stocks. I know that's for your members. But what areas are you looking at? What areas do you like?
So I went through the IGV ETF and I own two stocks from that. And there really is no way to classify it except to say that every holding that I have is unique. So one is a pure B2B company, which I think gets acquired at a fat multiple. The other is actually a beneficiary of AI. So everyone thinks, oh, software is going to get eaten by AI. What they don't realize is that even the software companies are using AI. So this is one of those companies which is going to be a net beneficiary of AI and vibe coding and that trend. And the other one that I own is specifically focused on Southeast Asia. So that's a huge market, and that market it's a young market. So that's the thing. Like if you look at US in the 2000s, people were young and they were more amenable to using software, and they were more amenable to using computers. And in fact, that whole drive of productivity growth came about due to that. So now we are seeing the same thing in Southeast Asia, except now instead of using computers, you are using your mobile phones. So it is all mobility driven, and then it's all convenience driven as well. So I own something in that space over there, and I am looking at other software stocks, but then it is very, very hard to find value. In fact, I got into this with someone on Twitter recently where I brought up the Salesforce chart and said, this thing has gone straight down. But if you look at the valuation, it is priced at 4.4 times sales. Now, for you to buy a stock which is priced at 4.4 times sales, it means you expect sales to grow something like 20-30% a year for at least 5-10 years. Now, if you're a small company, you can achieve that kind of growth. If you are, say, a 10 billion market cap company or a sub 50 billion market cap company, you can achieve that kind of growth. If you're a $170 billion market cap company, is it really reasonable to expect that kind of growth to last a long time? Well, not really. So it makes Salesforce kind of pricey, not too pricey, but a little bit too pricey for my taste, especially when you compare to all the other stocks that you can get, which have the same 20% growth and have much lower market cap, which means they can scale much faster.
Yes. So that makes sense. And just looking at technology generally, it's interesting because that's the thing, when Kashap talks and everybody's like, oh my gosh, he's so bearish. And it's like at the same time, he's long software, he's long Bitcoin and these other things. So, listen to what because that's the thing. We can all talk about what trading is, but seeing what the actual positions are, how we're actually positioning our portfolio, is going to tell you more than anything. Same with anybody out there. You know, you could talk to Buffett, could say, "Hey, I'm raising cash," but you could also see his positions and see what he's actually long. Yes, his time frame is going to be a lot longer than most people. Same with Druckenmiller. You can see that he's long certain areas, even Brazil and so on. You know what he's thinking because of that. He might say something on TV. Same with Tudor Jones, might say like, "Hey, it's party like it's 1999 because this is going to end." But at the same time, it's you want to continue to understand how people are positioned to really understand how they're really trading this market. Because most traders, I mean, you have to be fucking skeptical. Like, let's be honest. Like, you have to have some skepticism when you're trading. That creates the, if you're skeptical, that creates the ability to get out of things. Even when you're long something, like for example, like you know, I can be long semiconductors. At some point, they could roll over. If I've had that skepticism in me, it makes it easier to let my stop get hit and so on. A lot of people go, "Oh my God, systematized means like everything's fine and you don't have to worry about anything." Yes, but then you're a human and you have to follow it. And you have to let those stops hit. You have to take those exit signals. You have to just do it, and that's hard to execute. So some people might find it easier looking at trades like, I mean, I get into trades I hate all the time. People don't think that, you know, this is something that's important to understand. I hate certain trades I've been in over the years. The
So,
Nasdaq in
so I'm
2023.
I'm gonna I'm gonna just yeah. I was actually coming to that. Like I remember we had this conversation way back in early 2023, and you were like, "I'm long semiconductors because it's showing relative strength. I'm long tech." And this was the time when Silicon Valley Bank, which was the biggest bank which lent to the entire technology industry, this was a time that they failed. And then we had this conversation, and you said, "I'm long and I hate it." And I distinctly remember that because that is so hard to do.
Yeah, because you get long and you hate it. Like, you get long certain times and you hate it, but that's okay. Like, that's how sometimes it's like everything is linking up for my strategy, my system, my methodology, whatever for this. And I might not like it. 2023 was one of the time, and a lot of people don't remember. You know, the end of 22 coming into 23, the market was headed towards a nasty recession. There was every reason to bet against the market at that point from a fundamental angle. However, technically, and also when the fundamentals misalign, meaning the fundamentals are bearish and the technicals start getting very bullish, most of the time that's a very good signal that the market's going to head higher. And so, you know, for me, it was like, I just have to take this trade, you know, hold your nose and just buy it. Same thing even with energy. You know, energy was one in 2020 that was probably an area that I never thought I'd be long again. And Kashop, you remember this very well, which is energy was horrible for years. I mean, like, you're talking 2014 on, you know, 2014 all the way to 2020. You had a couple bounces here and there. I think, you know, 2016, 2017, we saw a little rally. Um, but nothing major, nothing sustainable. Then 2020 happens and you get this huge move. And if you weren't able to just hold your nose and buy it, you missed out on the best large cap sector trade of that 4 year period from 2020 all the way to 2024. So once again, it's sometimes you just got to do it. And sometimes technology is it. Sometimes energy is going to be it. Don't be afraid to move around from sector to sector. So coming into copper futures against the 30-year yield. So I'm looking at this chart here pretty much every day currently, you know, just seeing where we end up. Copper continues to hold up extremely well. Even though there's been some down days in the market, down days in commodities broadly, you still continue to see that copper is holding up. Like, the down days are very small, the up days are large. That's a really good sign that copper's headed higher and will continue to head higher. And then if we look at the 30-year yield compared to these things, I mean, if you just draw a line here and a flag, now, once again, I usually don't do a bunch of technicals on the yields themselves. I will do that on the bonds, but you're starting to see this kind of flag pattern and we're breaking out slightly to the upside. Now, I want to see it take out this old high. That would say a lot to me, but I do think yields are headed for 6, 7, 8% probably coming up soon. A lot of people think that's crazy, and you know, I keep hearing about the Trump won't let that happen, or the Fed won't let that happen, or this fucking fairy tale person won't let this happen. Whatever. I also used to believe in Santa Claus when I was a kid as well. I don't know exactly what these people are going to do, what they won't do, what they will do. But I know that the Fed does not have control over the long part of the curve. We've seen that again and again. I've shown that chart a million times, which is the Federal Reserve lowering rates and our rates going higher, the Federal Reserve raising rates, our rates going lower in the 30-year and so on. So the Fed controls the short end of the curve, meaning, 1 month to 1 year bonds, even 2 year bonds, they have some control over. Once we start to get to 5, 10, especially the 30-year bond, they do not have control over this area. So this continues to widen out. And I think as long as, for me, this is the liquidity environment that also helps Kashop's Bitcoin trade, that Kashop really nailed the bottom on that one, which is liquidity. So as liquidity keeps coming into the system, we're going to see the Bitcoin move higher, and I think we'll continue to see other things move higher. But liquidity being in the system can't only come from QE that's going on currently. I think it'll still come from the Fed just holding rates down here as the 30-year continues to move higher, because basically banks will lend more money because they borrow from the short end of the curve and lend rates at the long end of the curve, meaning they're making the middle there. So they make more money during those periods of time. So I think we'll continue to see that spread out as long as the Fed either holds rates here or moves rates lower. So I think we're in a scenario here where we got a lot more upside in yields to go, which probably means we have a lot more upside in copper and possibly oil to go. Kashop, what are you thinking about the commodities? Copper, oil, they're looking quite interesting here. Everybody's writing them off. Everybody's written off metals a long time ago. We don't need gold anymore. I guess we don't need gold or silver or any of that anymore. It's all party's over. Same with copper. Gold, silver, you can make the case, hey, it's under some pressure. We can see that. But if you're looking at copper, it's like this thing's just raging to the upside. You look at the other industrial metals, they all look really good as well. So what are you thinking about the metals and energy currently?
So
Well, we'll get into
copper,
energy later, actually, because I forgot I brought a chart of energy. But let's talk about the metals.
so copper, if you look at what Freeport said, they said that they are going to have to that's the world's biggest copper miner. So they said they have to lower production. If you look at what Chile is saying, so Chile is the world's biggest copper producing nation, and they are saying they are going to have production cuts. And the reason for all this is, and if you look at Aussie miners, Australian miners, they are saying the same thing. So the reason for this is copper is present in oxide ore. And when you need to get the copper out of that ore, you kind of need sulfuric acid for that process. And sulfuric acid for that process comes from sour crude, and sour crude comes from the Middle East. So when the Middle East sour crude isn't going to the refineries, you're not getting sulfur, so you're not getting sulfuric acid, which means you can't leach the copper out of your oxide ores, which means you don't get copper. So this is how that supply chain goes. Now, the more these problems persist, all these higher cost mines, copper can keep going higher. And if they cannot procure the acid, if they cannot procure the diesel, so diesel would be something like 5% of your mining cost. And what if you can't procure diesel because the country says, we are going to prioritize diesel for our trucks, we are going to prioritize it for keeping the economy running and not this mine. So in that situation, copper production drops off a cliff and prices can go much higher. And you also have, like, since you brought up the HG, that is the US copper futures. So you also have this discrepancy between London and the US. So you have this arbitrage going on there as well. So usually you'd see US copper trades at a premium to European copper. So that's another dynamic. I don't know exactly how that plays out, but this is a legacy of Trump's tariff threats. So you see that angle going on there as well. So all of these net tell me to be very bullish copper, but with the caveat that being bullish copper does not mean going and buying copper miners willy nilly, because you buy copper miners, let's say you buy something which happens to shut down its only mine. Well, then copper can go higher and this company is losing money because they're on care and maintenance. So you have to be very picky and very selective about what you pick, or just trade the futures outright to express your views. And that's kind of going to be the case with energy as well, because I mean, it's to me, it's obvious that there's a lot of manipulation going on with these energy futures contracts, the oil futures contracts. So in this scenario, you can be absolutely sure that the fundamentals demand a move higher and still lose money trying to trade that move. So I would be very, very cautious in how I express my macro view on either copper or energy.
Yeah, I think it's going to be a significant trade going forward. I think the big thing to continue to watch for here is, the underlying commodities. As Kashap said, the futures are going to be definitely an interesting thing going forward. I know a lot of people don't trade it. I've said it a million times. I'll say it one more time, which is please learn to trade futures. I've been talking about this since 2020. If we look at those periods in the 70s and so on, even the 2000s, what traders made the most money? I mean, historically, what traders make the most money, whether you look at every investment championship and so on, it is always the futures traders. Futures traders usually make more money than most of the traders that's talking options, stocks, and so on. You have a much of leverage. You also don't have theta, meaning time decay, and so on. So it's a really good thing for people to get into. More people should look into it and to start so you don't lose, money trying to learn how to trade it. Very similar to options. Try to do that with a paper trading account. I know some people on here are actually doing that right now. I love to see it. Just keep it up going forward. So looking at cotton, cotton is one of those that's always a little bit interesting, which is nobody gives a shit about it. Until it moves, then everybody cares, and everybody's like, "Oh my gosh, have you seen cotton?" I always find it funny when people, because people always will write me first to tell me these things. Have you seen cotton? I'm like, yes, I've seen cotton. So we got long cotton. Once again, this is one of those contracts a little bit tough to trade. Most people don't have access to trade it because this getting dip market data for the softs is a little bit expensive, so people don't like to spend it. However, if you do spend it, these softs make a lot of money. And it is well worth your time to buy the market data to do so. Looking at the Bollinger Band squeeze at the bottom, and everybody who knows me, even Kashap, we talk a lot about the book Bollinger on Bollinger Bands. Great book, really tells you about these, and then you can kind of create systems and strategies. Basically, you take a normal breakout system, let's say 100-day highs, and let's say the win rate's about 40-50%. You add a Bollinger Band squeeze on top of it, that win rate becomes a lot higher. So the win rate becomes about 60-70%. So the band squeezes are always very significant. So you see this basically became completely dead money for a very long period of time. I mean, nothing happened. This was probably the longest time I've seen a commodity die for long periods of time, but not to this low of volatility. Usually it's in a pretty big range. Volatility is a little bit higher. This thing was dead in the water. And then once it finally broke out, really got a good move up and over that 200 week MA. Once it started to do that, it really hasn't looked back. So I definitely think the cotton market's another place for people to continue to look at. Once again, I know nobody trades it, but if you are long it, we've talked about it. I've talked about it a couple times. If you are long it, just continue to stay long that market, and we'll see where it ends up. So getting to gold against the S&P 500. So gold against the S&P 500, we kind of see that it has an interesting correlation with silver most of the time, which makes sense. Once markets are really running to precious metals and they really like precious metals over stocks, money starts to flow into that sector. And next thing you know, you start to get a very risk-on look in the precious metals market. So looking at gold to the S&P 500, still in an uptrend. It's come down quite a bit recently with this big move in stocks, but still in a strong uptrend. And then silver, similar thing. So I thought we haven't talked about silver or gold much lately. So I thought, we'd talk about this a little bit more. For me, it's kind of like, hey, a lot of like gold doesn't look too bad. Silver is not a long yet, again, for me. But the miners are holding up pretty decently if we're looking at the large cap names. Kashap, are you still holding any of these gold miners, silver miners? What do you think about gold and silver currently, or any of the precious metals?
So year to date, I haven't sold or taken profits on anything in the precious metal space. And the reason for that is these are long-term uptrends, and I don't want to give up my good cost basis. I don't want to give up my compounding trying to predict these short-term moves. And the reason I say this is a very long-term bull market is because, like I said, I talked about the central banks and their gold positions. So if you look at silver, so silver, it has been stuck under $50 since the 2011 peak, and it has finally started moving, and it is sort of playing catch up to the rest of the commodity space. Now, it is not going to stop, and the reason it is not going to stop is also if you look at when gold moves parabolic like this and becomes more expensive for everyone, and it starts getting accumulated by central banks and big institutions and the HNIs of the world, what do the people who don't have as much money do? So if you go back to say 2023, I think, so when gold started its move, people in Hong Kong, the small savers, they started switching to gold beans, which is probably less than 1 gram of gold. And now those same people, instead of going to gold, they are now going to switch to buying silver coins. And you know, if it goes even crazier, we may see people start to buy copper tons like we saw in the 2011 bull market. So when gold goes up a lot, it tends to drag silver with it. Now, the interesting part of the cycle right now is I mentioned how the copper miners are kind of going to be struggling, and a lot of silver is mined in along with zinc, lead, and copper. So when these mines start to shut down, the silver production that's going to hit the market, that's going to decrease. And when you see the reduction in supply, you're going to see prices go back up again. So I think after going parabolic, there is going to be so corrections take place in both price and time. I think we got a decent correction in price, but not a decent correction in terms of time. So I think once that happens, you're going to see both gold and silver move higher, and silver probably is going to move a lot higher than gold in percentage terms.
Yeah, I agree with you there. I think it's you're just gonna have to be patient here, more than anything. It's like it's either like you're in positions like a shop and you're waiting patiently, or you're waiting for the next move higher, figuring out however that signal is gonna come for you. But I think the thing I would like to say, if it does start to move, I think a lot of people are gonna be very skeptical of it. For example, let's say gold starts to get back above, 5,500 or something, or 5,300. People are not going to want to buy this thing. People are not going to want to touch it. I think that that's probably going to be the time it really takes off. Some of the positions, we still have a few positions in our portfolio currently as well, and some of the positions are holding up really well. I think the ones that are showing the most relative strength will probably lead the next cycle. And I do think that this can move a lot higher. So once again, it's a be patient here. We're kind of seeing some signals of some bottoming, but you still want to be patient. You still want to sit on your hands. You still don't want to do too much here. And that can either be just holding and waiting or waiting for your right entry. Um, so looking at emerging markets here, international has done really well, Europe included. Starting to see Europe finally start to shape up. That's also really to do with the euro more than anything, as you know, Kashop. And so, but also we're seeing emerging markets start to really make a big move. They bottomed right here. We talked about this a few weeks ago, which is this going to bottom? Was this a top? So many people had so many different thoughts about it. To me, this was a bottom. I should take the question marks off of this, but the dollar hasn't really shown me completely that it's a top until it's really broken down. I personally believe it's a top. I don't think that this thing's got many legs to move a lot higher in the dollar at all. But passing that to you, Kashop, what do you think about the international trade still? I know you've mentioned Africa. Are you looking at any areas that are, and not to mention, like, let's talk about country wise, but talk about like what sectors you're looking at in certain areas. I know a lot of people don't know, like South Africa has like software stocks. South Africa has other stocks besides just gold miners and palladium and platinum miners. So what are you thinking about these different areas? Where do you think you want to be? Are you buying, you mentioned software, other things that you're buying. Are you buying any areas in any specific countries?
So I was looking at South Africa just this week. So in fact, I was looking at a couple of retail stocks in South Africa, and the problem is that this environment has made things really tough for Africa because with the Strait of Hormuz closed and with problems in the Red Sea as well. So it's going to really hurt their supply chains. It's going to hurt their availability of fuel, of reagents, of pharmaceuticals, pretty much everything. So because trade is at a standstill, Africa and Southeast Asia are going to be affected more or less similarly, and that is why I wouldn't touch retail. Otherwise, I'm very interested in South African retail. I am very interested in their food processing or their agriculture related businesses. But the problem is, under current circumstances, it's very hard to tell how this goes. So I'm waiting and watching. But if the war, let's say the war were to end tomorrow, it is peace all around. The Strait of Hormuz is open, and we just need to repair our supply chains, and life goes back to normal. Then I would just be going on a buying spree all across Africa, whether it's telecom, whether it's banks, whether it's retail, and of course the mines. So I would be looking all around it. The only problem with buying Africa right now is you don't know how this war progresses. And that is the only concern. Otherwise, I think pretty much everything across that continent is a buy.
Yeah, I think so too. I think that a lot of people are just going to kind of overlook that fact and just go, hey, this everything's fine. Don't worry about it. We got the United States over here. I mean, people are getting on TV literally saying that, nobody could possibly produce a 20% return last year except for the United States. And almost not every country, but probably at least 75 to 80% of all the country ETFs outperformed that by far. We're looking at 50 to 100% returns in some of these. So it's very interesting that people just kind of keep overlooking all these different areas, because that's the thing about it. It's like, you go where the alpha is. Like, who gives a shit about like the returns? Like, you're thinking of, oh well, I was in like 2021, for example. Oh, I was in the Nasdaq, it was fine, it went up that year, it made some money. And it's like, yeah, but energy made a lot more money, commodities made a lot more money, a ridiculous amount of money. So you just want to continue to move to where the alpha is, because even if the market's like like let's say the market goes into a bear market and you're still in where the relative strength is. Not saying like as a trader, you're especially short-term guys or even medium to long-term guys, you don't want to still just hold things that are in downtrends. But for example, like, 2020 is a good example of this. Gold had the smallest drawdown out of anything out there. Semiconductors too. Sorry. Also, I have to add semiconductors. And if you would have held both of those into that next year, those were the leading sectors in Q2, Q3. So gold topped out around August 2020, and then semiconductors obviously ran a lot longer. So once again, you want to be in those strongest sectors and the strongest areas, and sometimes those are in different countries. Don't be afraid to follow that. This is copper futures Aussie dollar pair. Just thought this was kind of cool. We don't really have to get into it, but once again, people were asking for more intermarket stuff and correlation stuff. This is one that's a great correlation that kind of shows you where copper prices are usually going, even though Australia and Japan have changed a bit over the years in their monetary policy. It seems like this correlation has stayed very similar. So wanted to pass this to Kashop because I had a couple things and I'm like, hey, this looks really good. A couple areas that look great. And it's more Kashop's wheelhouse more than mine. And so fundamentally, what are you looking at uranium? I know you've picked some great uranium names over the years. And so are you looking at domestic uranium? Are you looking at anything in the uranium space? Do you think this is, already ran its course, or do you think it has a little bit further to go?
No, I think the big move in uranium is just getting started. It's going to surprise a lot of people. So the reason for that is you have to go back to the sulfuric acid point that I made earlier. So it's not just copper. Sulfuric acid is so important for uranium that so Kazakhstan, which is the world's biggest uranium producing nation, they ran into such a big shortage of sulfuric acid that the mining company said, "Hey, we are going to spend some capex. We are going to build our own plant just so we can secure our sulfuric acid." So it became that critical for them. Now, this shortage is going to hit mines across the world, so it's going to hurt uranium production as well. And now that, thanks to the war, uranium is once again in the news, and then once it's in the news and people see there are shortages building, I think it's going to have an explosive move. So last year I bought a stock called Energy Fuels. I got in at $4, and it's right now at $20. And of course, I caught the wave pretty well, but right now, I have added another uranium stock to the portfolio, and I'm evaluating two more uranium stocks. Maybe I'll buy one or two of them. And the reason I'm adding so many uranium stocks and I'm bullish uranium to the extent that I haven't taken profits on a company where I'm up something like 400% is because I think this move has a lot of room to run. And if you look at past uranium cycles, whether it's 2000 to 2007, when one of Cameco's mines got flooded and uranium went absolutely bonkers, or you look at the Cold War era where the US was actively funding uranium exploration throughout the Western United States. So you go back to all those eras and you look at what uranium stocks have done. Well, 10,000% gains are they are extraordinary, sure, but they can happen in a cycle. Now, I'm not saying those will happen in this cycle, but I can easily see a lot of 10x, 20x winners coming out of the uranium cycle. Coming out of this uranium cycle. So, if you're not in the move, I think this is a good point to get started.
Yeah, I think so too. I think we're kind of looking at this and a very similar setup in rare earths. Rare earths came back a little bit, but I still don't see this as a problem. I think this has plenty more upside to go. And before we go, let's get into this a little bit. So I wanted to, Kashop, you mentioned that you brought something today. I wanted to give some time to talk about this. So what are we looking at here?
So we're looking at a chart of the Breakaway Tanker Shipping ETF, which is the BBET ETF, which is it follows freight futures, which is mostly Middle East to other parts of the world, so mostly Middle East to Asia. Now, this is an ETF which is linked to futures contracts, which are linked to the prices that people pay to the vessels in order to load their cargo and transport it to a destination. So it's a derivative of a derivative of a derivative kind of situation. And now the Baltic Exchange, which determines these rates for the futures contract, so they are saying that they are going to suspend their benchmarks. And the reason for that is because if oil and LPG are not getting transported, what is the what is the benchmark going to be based off of? It's not going to be based off of real contracts made by real ships. It's not based on real returns that are the ship owners are generating. So it's basically it's manipulated data. So what you're seeing on the screen right now, it is manipulated data and it is being influenced by a few big actors. So when you have a futures product like this, and you and I know we have seen this in with the I think it was X forgot the name now. It was some XIV or something in 2018 where in a day it was like down 80% or 90% and it was finished. And then when we saw oil go negative, you saw USO, the ETF, oil linked ETF, implode the same way. So I think we are setting up for a situation where if the Baltic Exchange says we are going to suspend these price quotes, this ETF can crash somewhat spectacularly. And looking at how parabolic it has gone, I think even if you don't know anything about these products, it's a good place to say avoid it because of the futures mechanics. And if you do understand what's going on, I think it's a good place to say this is a disaster and it's going to be similar to the XIV and the USO disasters that we saw in 2018 and 2020. So there's more of a warning. Don't just go with the angle of a chart. Really try to understand what's behind the ETFs, especially when you're buying futures linked products. Now, if you're buying wheat, if you're buying cane, those are well structured products and those commodities are not exactly the futures contracts are not exactly manipulated or anything. So you're getting real prices translated into the ETF prices. Whereas in a ETF like this, you are not getting that. So you have to be aware of it.
Yeah, no, that makes sense. And so let's get to a couple questions while we have just a second. So this one came up. If the market favor, and thank you. If the market favors low cost miners, would you prefer CopX or CopJ? How about multi metal miners? So this is to you, Kashab.
So I don't trade the ETFs. So I think that's more Jason's thing. I prefer buying the individual stocks.
But think
The
about it
multi
individually, and then think about it like, would you want the larger names or the junior names?
I would want the junior names, but not a single asset miner. Because if you have a single asset miner and let's say they are in Chile and Chile says no more sulfuric acid or diesel for you, and then you have to shut your mine down. Well, do you have a mine somewhere else that you can sort of keep going to get take advantage of higher prices? So in that sense, if you're looking for multiple mines, if you're looking for a company with multiple mines, then it favors the large caps. But then the problem with the large caps is like what we just saw with FCX. So you have those issues. So I would just say you need to be it cannot be COPX, it cannot be COPJ. It needs to be very, very specific, or just trade the copper futures. That's going to be so much easier than trying to find these miners. Now, full disclosure, I own Hudbay, and I think I'm up around like 200% on that stock. So I own Hudbay, and I will continue to own it through the cycle. But if I have to think of what I would be getting in right now, I would really, really think twice about getting in right now, and I would want a decent enough correction or at least clarity on the diesel situation before I buy in.
No, that makes sense. All right, guys, we got to get out of here. Thank you guys for joining us for the Holy Macro Show. We'll be with you guys next week at 10 a.m. Eastern Time. We'll see you guys then.
Bye, everyone.